But before anything else, let's chat with Saurabh Chawla, the Senior ED Finance at DLF. Saurabh, hi, congratulations. You've personally spearheaded the deal with GIC, which is now India's largest FDI in real estate. Yet the DLF stock sold off on Monday. Do you think it's because the market was expecting the promoters to offload 40% instead of the 33% which has been announced?
No, I think the market is waiting for the details on the transaction. So initially, of course, the market reacted to the press release. But once we explained the overall contours of the transaction to the investment community, especially through our analysts, I think they will realize that this is a much better deal than what was earlier envisaged. Because in this construct, DLF's share is also going up from 60% to 67%. Which is a great validation that DLF also believes in the future growth story of commercial assets as it goes forward. The second aspect is, in this whole process, based on the recommendations of not only GIC but other private equity players, when they gave us a feedback that the capital structure of a DCCDL needs to be harmonized because it's generating substantial amount of cash. And hence, we rationalize that capital structure also. So in the hands of the promoters, the same amount of money goes, whereas DLF builds up another 6.67% of stake, and we sell out actually a lesser amount to GIC. So in broader construct, we achieve all our strategic goals of capital raise by selling out actually less equity.
So Saurabh, what do you say? The deal is better than the original plan of promoters selling out 40% in the rental arm? Why do you say that?
So very clearly, I mean, when the stake actually got built up in 2010 itself, our guidance to the market was at some point of time, this will get assimilated in the DLF Topco or the Listco. So this is just one of the milestones that we are achieving before the final monies come in from the promoters after the closing of this transaction. So it's just a promise that is being met in the capital markets. We have, whether it is the debt capital markets or equity capital markets or the banking markets, we have demonstrated, I would say, the highest standards in our governance and management. Markets have been soft. Those are cyclical issues, which I think over a period of time, I think you will start seeing a lot of value also emanate over there. But purely from our standards, we have never shied away from meeting our commitments where we had earlier guided the markets to.
Fair enough, Mr. Chawla, but give us a sense, by when will the funds be infused into DLF? You've given a guidance for November. Do you stand by that? And do you think it would be spaced out, the infusion?
No, there won't be any second stage. It will be a one-time infusion. So the whole money will come in. It will be in the form, most likely, and again I'm giving a disclaimer because yet to be agreed with our shareholders. But no, most likely it will be in the form of warrants because we have to comply with the guidelines of SEBI on public float and how much the promoters can get allotted to themselves, which is not more than 5% in every fiscal year. So I mean, there are many constraints in which the instrument has to play out. But yes, the whole money will come in from the promoters in a short period of time after the closing, which we envisage by end of November.
Right. But, while I appreciate there are instruments like warrants at play, give us an idea of the quantum of infusion that's likely in DLF.
Sure. So the infusion will be by the promoters in the range of 10,500 crores, depending upon what the net tax that they have to pay on the proceeds. So let's assume it's a 10,500 crores from the promoters. Obviously, in order to maintain the 75-25% ratio, there will have to be an issuance to the institutional shareholders. So that is, in total, I think we should get about 13 to 13,500 crore rupees within this current fiscal year.
Right. Mr. Chawla, this has been described as the game changer deal, as it will once and for all solve DLF's mammoth debt problem. can you reconfirm if DLF and promoters stand by the commitment to use the GIC deal proceeds to cut down debt, and by how much?
Yeah, I mean, we have clearly stated that the whole proceeds will be used to pay down the debt which is actually attributable to our development side of the business, and the 13,500 crores will be used towards that. The current net debt on a consolidated basis in DLF is about 26,000 crores. So that will come to half, which is almost 13,000 crores. And but there is also debt in DCCDL, which is about 5,500 crores. So the net left after many of these series of transactions in DLF development company will be about 6,000 crores. And out of this 6,000 crores, about 4,000 crores is associated with the rental assets which are already there in DLF. So the serviceable debt from the development side of the business will come down to almost 2,000 odd crores. So still a lot of journey for us to go forward, but once this transaction gets completed, there will be a substantial reduction. Actually, our net debt will come down by half. So that's the positive side.
So what you're saying is that the net debt will be sub 1,000 crores. I mean, I just want you to clear the air here.
Our net debt will be sub 10,000 crores post all the transactions, yes.
Okay. The joint press release by GIC and GIC, that is, and you guys, DLF, talks about future collaborations. The promoter and the DLF Vice Chairman Rajiv Singh talk of GIC and DLF unlocking value together in the future. Throw some light on, you know, what this kind of collaboration and value unlocking is going to be all about.
Well, if you look at our presentation, you know, the entity of DCCDL itself is embedded with almost 19 million square feet of future development. That's the magnitude of development that we can do, creating more offices and retail spaces across the country. Currently, we are developing almost 4 odd million square feet of offices in Gurgaon. So you are talking about more than doubling with the embedded you know, development potential within this entity itself, and that's what I think Mr. Singh and Lee Coxon have been referring to, that this will enable us to capture the growth story in the office and retail space across the country. What also, which we have actually talked about, and if you must have noticed, is that we're also talking about inorganic growth. So we would be looking at opportunities in places like Mumbai, Bangalore, where we do not have presence in the commercial space, and these are very large office and retail markets. So there's no reason, with the expertise and the financial backing of GIC, we not only enter into those markets but also expand our operations over there. So, you know, the sky is the limit for this entity with GIC's backing and discipline of investing, I think, and our development potential and expertise in our operations. I think it's a very compelling proposition for GIC as an investor, and for DLF investors, DLF shareholders indirectly.
Right, the market is liking what you're saying, Mr. Chawla, and I think that's where the story lies, in reducing debt and getting the operational efficiencies back. So from what you're saying, DLF will have to buy land in the expensive markets of Mumbai and Bangalore. Won't the company then again have to raise more debt? I mean, how are you going to manage your capital requirements versus, you know, cash flows from current projects?
So this entity itself, so number one, I want to clarify that this is not a residential play, this is a commercial play. So DCCDL will not be entering into residential development. So that's number one. Number two is this entity at the current run rate throws up almost 1,200 crores of, you know, cash, and this cash on an annual basis, and this cash is only growing. So this cash has to be well utilized, and hence if we were to lever this cash up, there is no reason that we do not actually expand in various jurisdictions. Debt by itself is not bad actually, if debt is serviced by stable rental cash flows. There is a substantial amount of equity upside to be made from that, And with GIC's expertise and our operations, I think that's what we intend to do.
So sort of the sense I'm getting that commercial real estate in DLF is a different focus today. Will that correct more, or will it be more aligned with the market reality?
You're right. I mean, where the markets are right now, with residential markets and many of the micro markets where we have presence being soft, our focus has been more on the commercial. I think what you really need to appreciate is that over the last 2 to 3 years, as residential markets entered into a very soft zone, we also had a lot of disruptions where it was not clear as to how we should run our business. So, real estate regulatory bill itself is whilst it's great, legislation to bring in transparency and discipline, but it also brings in uncertainty, and we have taken a little conservative view as to how we should play it out. But now that everything is enacted and there is clarity on this, on the regulatory aspect of it, on the tax aspect of it, on the GST, we believe that we are very well positioned also now to grow our business on the residential side. But I think we will right now still guide the markets that we'll have a relook at it in the next 2 to 3 quarters before the growth starts to emanate from there. So I think we are well positioned. The timing of this transaction is also quite good, that we will have a very focused commercial development and asset owning entity, and with everything behind us also on the residential play, we can start relooking as to how we do that business also.
Right, Mr. Chawla, REITs are the new fad for real estate companies. What about a REIT listing? Is that still on the table?
So I think what we have done with GIC is actually create a business trust. So in a business trust, there is a higher degree of development potential. In a REIT, there is a lower degree of a development potential. As you're aware, GIC is a sovereign fund. They are not like private equity. Private equities like to exit in 4 to 5 years time. GIC, being a sovereign, being an LP to most of the private equity players, can be actually in your portfolio for decades. I mean, some of the longest holding investments they have is almost 50 years. So there is no pressure of exit over there, as long as the markets are growing and both the partners are happy, growing that embedded value also within the portfolio. We were happy. So the way we look at it in DLF, we've already created a business trust. Now this business trust will decide at what point of time they go to the capital markets to give a better visibility on the market value of that investment in that REIT. So we really don't need to encash on our assets to go into the REIT market. The board of directors of DCCDL will decide, or DLF and GIC will decide, okay, this is a good time to monetize some assets within DCCDL and demonstrate that value there.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.